On June 12, 2026, SpaceX went public at $135 a share. By the closing bell, it sat above $160. The company was worth more than $2 trillion, and Elon Musk became the first trillionaire in human history. Every headline ran the same story. Here is the one they didn't run. 12 days later today, Musk is no longer a trillionaire. The stock has fallen more than 30% from its peak, and roughly $250 billion of his fortune evaporated in a matter of sessions. The crash isn't the surprise. The surprise is that the structure of this IPO made the crash almost mathematically scheduled, and it was all public the whole time. Let that land for a second. SpaceX's IPO had two structural features almost no major listing has ever combined. 1. Accelerated entry into the NASDAQ 100 faster than any company before it. 2. An early release valve on insider shares well ahead of the standard lockup. Now, here's where it gets interesting. Both features point in exactly the same direction. The first one shoves buyers in early. The second one lets sellers out early. Buyers first, sellers second. Hold that frame in your head, because everything else is just the math underneath it. On March 30th, 2026, weeks before the IPO, NASDAQ changed a rule. The old rule: new stocks waited 3 months to a year before joining the NASDAQ 100. The new rule: a top-ranked company can enter after just 15 trading days. That 3-month wait existed for a reason: price discovery. Let the market figure out what a stock is worth before forcing index funds to buy it. SpaceX got the 15-day version, written for exactly this listing. Why does that matter? Hundreds of billions of dollars track the NASDAQ 100. The moment SpaceX joins, those funds must buy it not because they like it, but because the index says so. That's not enthusiasm. That's a mandate. But here's the twist: the source-style version of this story usually gets backwards. SpaceX floated only about 5% of its shares. A tiny float. You'd think a small float means a smaller forced purchase, and on the index weighting side, you'd be right. NASDAQ's float adjustment rules actually capped SpaceX's weight. Roughly 1% of the index instead of the 5% its full size implied. So the index buying was real, but throttled. The explosive part wasn't the index, it was scarcity. When almost nothing is available to buy and everyone wants in, price doesn't discover value, it discovers desperation. So when do the people who actually built this company get to sell? A standard IPO locks insiders up for 180 days. 6 months. The point is to stop early holders from dumping inflated shares on the public. SpaceX split it. Musk and top insiders agreed to a long lockup over a year. But other pre-IPO investors got something unusual: early release tied to milestones. After the company's first earnings report, expected late July or early August, that group can sell the equivalent of around 7% of all outstanding stock. Read that again. 7% of the entire company can hit the market within weeks of the IPO, more shares than the IPO itself floated. And a separate slice unlocks early if the stock simply trades about 30% above the offer price. In other words, strength itself triggers selling. Stop here, because this is the whole game. Insiders who've held since the 2000s, with a cost basis near zero, can start cashing out while index funds are still buying. And while retail, about 30% of this deal was steered to everyday investors through Schwab, Fidelity, Robinhood, and others, is still holding. Retail isn't the audience. Retail is the exit. Now the number nobody put in a headline. Morningstar, not a short seller. A mainstream research firm, values SpaceX at about $63 a share. Roughly $780 billion. The market priced it above $2 trillion. At one point, SPCS traded at more than 3 times Morningstar's fair value, making it one of the most expensive stocks they cover anywhere. Morningstar's own words: at the offer price, Buyers were paying about a $72 per share option premium, money spent purely on a future that may or may not arrive. Their most optimistic moonshot scenario, reusable Starship flying weekly, data centers commercialized in orbit, gets you to $154. They assign that outcome a 7% probability. 7. Meanwhile, the business loses money. Roughly $4.9 billion in 2025. Billions more in the first quarter of 2026. Starlink is genuinely excellent and genuinely profitable. Almost everything else is a bet. Active managers who run valuation models won't touch it here. Passive funds already bought what the rules force them to buy. So who's left to absorb the shares when insiders start selling in August? You see where this goes. Zoom out, because none of this is new. Facebook, 2012, priced at $38, then slid into the high teens within months as the lockup unwound. Uber, 2019, priced at $45, and on the day its lockup expired it cratered into the mid-20s. Snap, Lyft, Alibaba, same arc every time. Manufactured demand at the open. Insiders temporarily restrained. Retail buys the story. Insiders sell. Price reverts. There's even academic backing. Research on companies that go public at price-to-sales ratios above 40 shows a dismal long-run track record. SpaceX listed far above that line. And here's the part that should bother you most: none of this was hidden. The rule change is on Nasdaq's website. The lockup terms are in the prospectus. The valuation is published. The history is on any finance site. You didn't need a Bloomberg terminal. You needed to read past the first paragraph. And it's happening right now. The insiders haven't even sold yet. Earnings haven't been reported. The lockup window hasn't opened. And the stock has already retreated more than 30% from its $225 peak, down to around $156. A single session plunge wiped roughly $240 billion off Musk's net worth and knocked him out of the trillionaire club he'd held for less than 2 weeks. Here's what that tells you. The $2 trillion valuation was never a floor. It was a ceiling. And the people who set the ceiling are the ones with the earliest door out. On June 12, every headline said a man became a trillionaire. Not one said that a chunk of this company's value existed only because an index rule was rewritten weeks before the listing, or that the earliest holders could begin selling in August while everyone else held the bag. The question worth sitting with tonight isn't whether SpaceX is a good company. It might be extraordinary. The question is whether the price you paid was set by what the company is worth or by a structure built so that you'd pay the most, right before the people who know the most got to leave.